going to talk about venture debt versus equity, when loans are best to help you scale your brand new idea. Now, this is for early stage founders who need cash. Not every business needs cash. Not every business needs funding to scale. There are plenty of models out there that you could be going after that don't require capital whatsoever, but some do require capital. And for those that do, it's really important to understand when debt is better than equity. Now, a lot of people that I've talked to are scared to raise equity from investors because you're giving up equity in your venture. So if an investor gives you $250,000 in exchange for 20% of your business, then you're losing out on equity or ownership of your venture. To me, that's okay if that capital is going to help dramatically increase the valuation of your business. It's still better to own 75% of a business that is worth 10 million than own 100% of a business that only makes it to a valuation of $100,000. So being afraid of equity is not necessarily the best thing. Sometimes raising equity makes a lot of sense. We're going to talk here in a minute about when they make the most sense. But so what venture debt is it's essentially a loan for an early stage startup. It's traditionally out in the marketplace known as debt for early stage startups that have already raised equity. So what most people don't realize is there's plenty of companies out there that are in high growth mode and they raise equity from investors, but they also have venture debt. They may have lines of credit to fund their business operations and things like that. The lenders, they're not necessarily looking for profit or hard assets like a traditional lender was. I spent 20 plus years in banking, and in that world, you're looking for someone having the ability to pay early on, and you're looking for collateral that you could seize and sell to recoup your funds if you have to. What a venture debt lender is doing is they're banking on the growth of that venture, and they're also banking on the venture capitalists that have already supported it to continue to support it, even if there are challenges. So now, another thing to understand about venture debt is in that definition, in the traditional venture debt definition, when a lender is giving you capital, they may also be taking out warrants, which give them the right to buy essentially equity in your venture at a later date and those types of things. But that's not the normal 15 to 25% that you would give up. So even if you raise traditional venture debt, you're still not giving up as much equity as you are if you're raising from a venture capitalist, an equity investor of sorts. Now, the reason I keep saying venture debt as it's known out in the main industry, these are places like Silicon Valley Bank, right? So this is a big venture debt lender. There are other venture debt programs, and you can get capital as just an individual who's starting a business, and I would consider that venture debt. It just doesn't meet the traditional definition of what I was explaining earlier. So I actually one of the awards on my bookcase over here is for a venture debt program that I launched at a credit union where I was chief lending officer at. And we gave ideation stage loans to early stage entrepreneurs. So they just had ideas. We were giving them somewhere between $10,000 and $50,000 to help get that venture off the ground. That's still venture debt. So even if you're using a credit card to finance the growth of your business, I don't recommend it because the rates are high, but there are people who do it. That's still venture debt. Okay. So, venture debt versus equity, it's just understanding when it's the right move. So venture debt is not for everyone because what you're doing is you are taking out a loan. This is not a grant. This is not free money. You're taking out a loan that you're going to have to pay back. Okay. When it's right for people is when your business model is predictable, when you have confidence in your cash flow that you're going to be able to make the payments. I mentioned a venture debt program that I launched. By the way, that was called the Line 12 Fund. Line 12 used to be the line on your tax return where your sole proprietorship income would pass through, and we called it the Line 12 Fund. That we gave those loans to people who had predictable income. If their business wasn't off the ground yet, they may had a day job that provided sufficient income for them to still make the payments, even if the business didn't create revenue. That's predictable income. Or there were some people who came to that venture debt program and they already had a business in flight, wasn't making a ton of money. They needed more money to actually grow. They didn't want to raise equity, and they had revenue coming in for that business. So venture debt works good when your venture model is predictable. It's also good when you have a specific use case that you know will create a return of income. So let's say that you've been in market for a while, or you've done plenty of market validation, like we talked about in week 2 of the 30-day founder blueprint. If you've done plenty of validation, you know that you can run ads, and the cost of that ad, the customer acquisition cost because of that ad to acquire a new customer is $10, and you know the lifetime value of that customer is going to be $200, then taking out debt could be a very good bet, right? So this is when you have a go-to execution plan that you know what's going on. It's also good to raise venture debt when you don't want to have what's called a down round. So if you've raised a previous round of fundraising through traditional equity investing, a down round is when your valuation goes down because you just, maybe it's a tough fundraising market, maybe it's a defensive move, maybe you've just not been able to execute like you think. That's another reason that venture debt could make sense to you. The flip side, equity makes perfect sense when you're pre-revenue, when you're pre-market fit, you need tons of cash that you're not going to be able to get in the form of debt, and or you need a strategic partner like a venture capitalist to come in, sit on your board, provide you with contacts, provide you with insights, all those different things. Venture debt has its risks. Again, it's debt. You have to pay it back. And a majority of time, you're going to be asked to do to sign what's called a personal guarantee, which means if the business can't make the payments, you'll make the payments. Now, there's 2 different types of covenants that can come with venture debt. There's a negative covenant, so it's going to restrict you from doing certain things, taking on more debt, for example, that type of thing. There's affirmative covenants, which require you to do things like maintain a certain amount of minimum cash in the bank or hit certain revenue targets, that type of thing. If you breach those covenants, then it triggers a default and the lender can actually come after you to make sure you make the payments in some way. So that's some things to really, really think about. The way I summarize this to you is equity is basically your sledgehammer. It's powerful, it's transformative, it's a big foundational change. You're raising a ton of money. Venture debt is a little bit more like a crowbar, right? It's perfect for creating leverage when you know how to use that leverage. It's really, really important that you think about it that way. Is venture debt easy to get for an early stage pre-revenue startup? Absolutely not. It's not going to be the right tool. That's when you're going to want to use equity. So if you are just trying to get off the ground, typical traditional venture debt is just not going to be right for you. It may not even be right for equity investors. Remember, we talked about accomplishing milestones and tractions. Venture debt works really well when you have a predictable model. Even if you have limited revenue, you know you've got enough to be able to make those payments. You can count on that revenue continuing to come in. That could just be personal income. If you're the type of person who has a high amount of income with discretionary income that you can afford to make the payments without even getting revenue out of your business, then venture debt could make sense. But I want you to be mindful of these things because whereas with equity, you're not signing a personal guarantee and you're traditionally not giving up any sort of collateral. So there's no way that investor is going to come after you if things go wrong. With venture debt, that isn't true. Usually the lender can come after you and force you in lots of ways that could be scary to make payments. But I say that to just say that sometimes venture debt makes sense, sometimes equity makes sense, and it's very, very important for you to understand the differences. There are plenty of avenues out there for venture debt. All you have to do is Google them. There are plenty of avenues out there to raise investor capital. It just depends on finding the right one that's going to work for you in the right phase of your business you're at. Know the differences. That'll keep you safe.